I want to make this a quick market update to give a little bit of certainty in an uncertain market. I want to explain the economy underneath the mortgage interest rates, what made them so volatile, and what we can expect going forward. We saw low interest rates on Friday and higher interest rates on Monday. That can make your head spin. Mortgage interest rates are falling again. Not necessarily on good news, and this is coming off of a 7.1% spike after hitting a year-to-date low of 6.55%. I mean, to see all of this volatility as a home buyer, you're probably thinking, you know what? I need stability. I want to know that when I go out shopping for a home and get pre-approved, the interest rates that I'm quoting are the same interest rate that I might see when I find a home and I put an offer on it. Right now, it didn't quite feel like that. Now, having said that, mortgage interest rates are falling right back into the narrow channel that they've been in since February. So given that, what just happened? I want to explain the economy underneath the mortgage interest rates, what made them so volatile, and what we can expect going forward. Because ultimately, as a home buyer, you like a little bit of understanding of what's happening. If now is the right time for you to purchase a home and make that big financial commitment, now is a fantastic time. There are opportunities. Personally, I am selling a property right now, and I'm 1031 exchanging it into another investment because I'm seeing the opportunity of being able to negotiate. If you're worried about the fact that you might lose your job or you might have to change locations due to finding a new job or job transfer, that's not the right time to buy a home. Let's jump into exactly what rates are doing, because I want to make this a quick market update to give a little bit of certainty in an uncertain market. So we all know that the volatility in both the equities market and the bond market happened primarily due to the tariff conversation. We saw a massive move from equities to bonds in a flight to safety, and that's when we hit our year-to-date low of 6.55% on average for the 30-year fixed rate. Now, just shortly after that, in fact, the very next day, we started to see it jump up, and then it continued to climb to 7.1%. And why? A couple of factors. One is you had people losing money in the equities market, and they had calls that they had to fund, and they had to sell bonds in order to do that. You also happen to be around the unfortunate timing of tax season, and a lot of people will do that every year. Well, they'll sell bonds in order to fund their tax bill due. You also saw a global effect or retaliation and imports on the supply of bonds. Now, there's a lot of conversation that China might retaliate and sell off the 10-year treasuries. This is important because when you think about it, whenever you have more supply than demand, you have dropping prices, right? We see that in the real estate market. We see that in commerce and supply and demand economics. When you have more supply than demand, prices drop. And the same happens for the 10-year treasury. Now, here's the problem. When the prices drop, the yields increase. It's an inverted relationship. And when the yields increase on a 10-year treasury, that's most commonly associated with the 30-year fixed mortgage. So the 30-year fixed mortgage rate goes up. So if China was dumping 10-year treasury bonds, that would increase supply. All of that, less trading, less supply of the 10-year there, the dumping due to retaliation, all of that went into effect, and why we saw the interest rates spiking. But all of that was temporary, which is exactly what Fed President Waller said this week. He came out stating that the Fed board's position on the tariffs implication on the economy and on inflation is temporary. And if that's the case, the Fed board has two mandates: inflation, or the cost of everything that Americans buy, and then should every American who wants a job have one, is their focus on labor, which primarily is measured by unemployment. Well, if they're not going to pay attention to inflation because they think it's transitory or temporary, then they're going to hyper focus on labor. And if labor breaks, they're going to swoop in with faster and bigger Fed rate cuts. As of now, they're still looking at 2 rate cuts for this year. So what is the economy that they're watching besides the labor market? Of course, the labor market is a big one, and we saw the unemployment report ticked up just slightly, 0.1%. In fact, that happened the day after the tariffs were announced, so nobody was talking about the unemployment report. Now, one thing that was in the report that nobody was talking about was the wages. Wages have actually come down. Wage growth has slowed, and with that, we're watching labor. Now, the jobless claims actually was lower than expected, meaning less people were laid off, yet the continuing claims increase, meaning once somebody is laid off, they can't find another job. When we're talking about the economy, we typically break down the United States economy into manufacturing and services. It's important that we watch this economy and what's happening, because does it and will it lead into a recession? That's the conversation that a lot of people are having right now. And as a home buyer, I want to make it make sense, because you're making one of the biggest financial decisions for your family of your life, and you want to do that on the best information that you have right now. Is this going to slow us into a recession, and is that recession going to result in a housing crash? And so I don't want to buy at the top is what I'd be thinking. So manufacturing is in fact slowing down. In fact, it just ticked down to 49. Any number above the index of 50 means that it's in an expansion, and any number below the index of 50 means that it's in a contraction. And now manufacturing has now dropped into a contraction with fewer orders, more layoffs, and lower confidence. Now services have also dropped. In fact, services dropped to a 9-month low. That's kind of a big deal, because the United States is primarily a services country. And when we stop spending money on services, we feel it. And that ripples into the GDP, which impacts a recession coming and the determination of a recession coming. All of this to say that the economy is slowing down and the consumers are feeling it. They're worried. They're worried about the tariffs. They're worried about the cost of everything. They're worried about whether or not we're going to go into a recession, and they're worried about keeping their jobs. Consumer sentiment plunged to a 3-year low. That is the significant report in all of these, because if they're worried, they won't spend. And if they're not spending, then the GDP is going to go down. That could also have a side effect of lower interest rates. A slower economy yields lower interest rates. Now, if you're a home buyer who has the stability and confidence of your job, who is looking at home ownership as an opportunity to build that future possibility for your family, or if you're an investor looking at negotiating opportunities, this could end up being a really good time for you before those interest rates do lower. But if you're a first-time home buyer and you're re-signing a 1-year lease, that's going to put you right into next spring with lower interest rates and more demand. Right now, we just saw mortgage purchase applications drop slightly because of the volatility. Volatility is fear-based, and fear-based leads to inaction for most buyers, completely understandably. I want to put this in the perspective of dollars, and this is where I want to land. We saw low interest rates on Friday and higher interest rates on Monday. That can make your head spin. But ultimately, how much of a difference is it making? I try to focus on the purchase price that fits your lifestyle, on the monthly payment that fits your budget and makes you comfortable, and on the down payment that doesn't make you house poor. Because the interest rate doesn't move the needle as much as people might think. If you're buying a $600,000 home, putting 20% down, that difference between a monthly payment at 7.15 and 6.75 is $130. If you're buying a $400,000 home and you're putting 20% down, that monthly payment all in PITI is a difference of $85 a month. Is $85 or $130 a month the difference between doing it and not doing it? There's dollars involved, and I get that. Having the stability, having the control, knowing what you're buying, building that long-term bridge to wealth, or sitting on the sidelines for another year paying rent to somebody else. Or if you're a homeowner living in a home that is not fit for you any longer, there is a lot of uncertainty. When you peel away the noise and the headlines and the fear, and you just get to what's real for you, a lot of times it hasn't moved that much. And that's what my team does best. And what I love to do is sit down and create strategy sessions to determine what's the right next best step. Leave the noise behind and make the best decision for your family's financial future with the information you have at the time. Understanding the economics and what's making rates move is ultimately giving you the power to feel confident despite what's going on around you that you simply cannot control. If you'd like to sit down and know your numbers, I would love the opportunity to do that. Nicole, Rueth, at your service, and I look forward to seeing you on the next video.